Before we begin, a quick and important disclaimer. The information provided in this video is for educational and informational purposes only. I am not a licensed financial advisor or insurance agent. This presentation is not intended to be a substitute for professional financial or insurance advice. You should always consult with a qualified professional before making any decisions about your insurance coverage. Your personal situation is unique, and the strategies discussed here may not be appropriate for your circumstances. You get that bill in the mail, you open it, and your jaw just hits the floor. Your car insurance premium went up. Again, you haven't had an accident. You haven't gotten a single ticket. You're driving the exact same car on the exact same commute you've had for years. So what gives? Why are you being punished? Feels random. Feels unfair. And honestly, it feels like you're being taken for a ride by an industry that holds all the cards. Let me tell you about two real people. We'll call them Mark and Jessica. They live in the same city, they both drive a 2021 Toyota Camry, and they both have a perfectly clean driving record. Not a single blemish. Yet, Mark pays $850 for his 6-month policy, while Jessica is paying over $1,500 for the exact same coverage. That's nearly double. For the same car, the same record, in the same city. How is that possible? It's possible because the price you pay for car insurance has very little to do with what feels fair, and everything to do with a complex, data-driven calculation of risk. Your insurance company isn't just looking at you. They're looking at millions of data points, running them through a secret algorithm, and spitting out a number. Your premium. It's a black box designed to be confusing. Well, over the next 10 parts, we are going to smash that black box wide open. We're going to pull back the curtain and expose every single factor, from the obvious to the downright shocking, that insurance companies use to decide how much money to take out of your wallet. By the end of this series, you won't just understand your bill. You will be armed with the knowledge to actively challenge it, shop smarter, and potentially save hundreds, if not thousands of dollars a year. This is the masterclass the insurance industry does not want you to see. So let's start with the one factor everyone thinks they understand, but most people only know the surface level of: your driving record. This is the foundation of your insurance rate. It's your personal driving report card, and every insurer is going to grade it. But it's not a simple pass or fail. It's a detailed story of your history behind the wheel. First, let's talk about the big one. At-fault accidents. If you cause an accident, you become a statistically higher risk. It's that simple. Your insurer had to pay out a claim, and they now view you as more likely to cost them money in the future. In response, they'll hit you with something called a surcharge. This is a direct penalty increase on your premium that can last for 3 to 5 years, depending on your state and your insurer. How much of an increase are we talking about? It's not a small number. A single at-fault accident can raise your rates by an average of 40 to 50% nationwide. Let's put that in real numbers. If you're paying $150 a month, that could jump to over $210 a month instantly. Over 3 years, that one mistake could cost you over $2,000 extra dollars. And if the accident was severe, involving major property damage or injuries, that surcharge could be even higher and last even longer. Now, you might have heard of accident forgiveness. This is a feature some companies offer, often for an additional fee or as a reward for long-term loyalty. It essentially gives you a get-out-of-jail-free card for your first at-fault accident. Sounds great, and it can be. But be aware, that forgiveness usually only applies to your current insurance company. If you decide to shop around for a new policy after that forgiven accident, guess what? That new company will see the accident on your record, and they will absolutely charge you for it. The forgiveness doesn't erase the accident. It just means your current insurer agrees to ignore it. Next up on your driving record are traffic violations. These are the speeding tickets, the red light camera flashes, the illegal U-turns. Insurers see these as red flags indicating risky driving behavior. Even if you didn't cause an accident, the behavior itself, speeding, reckless driving, makes you statistically more likely to cause one in the future. Just like accidents, violations are categorized by severity. A minor speeding ticket, say for going 10 miles over the limit, might only raise your rates by 10 to 20%. Annoying but manageable. But a major violation? That's a financial catastrophe. A conviction for a DUI or DWI is the single most destructive event for your car insurance rates. On average, a DUI will increase your premium by 70 to 100%, and in some states it can be far worse. We're talking about your rates doubling or even tripling overnight. And it doesn't stop there. After a DUI, your insurer might drop you completely. forcing you to find high-risk insurance. You'll also likely be required by the state to file an State Route 22 form, which is basically a certificate your insurer sends to the DMV proving you have coverage. This State Route 22 flags you as a high-risk driver to every insurance company in the country, and you may be required to have it for 3 years or more. That one terrible decision can easily cost you an extra $10,000 in insurance premiums over the next few years, on top of all the legal fees and fines. The key thing to understand about both accidents and violations is that they have a shelf life. They don't haunt you forever. Most insurance companies will only look at your driving record for the past 3 to 5 years. This is called the look-back period. So, that speeding ticket from 4 years ago, it's likely about to fall off your record. When it does, your rates should go down. This is a critical moment to reshop your insurance. If your current company doesn't automatically lower your premium once a ticket or accident expires from their look-back period, another company, seeing you as a fresh applicant with a now clean record, will gladly offer you a much better rate. You have to be proactive. So, your driving record is the baseline. It's your story. A clean record opens the door to the best rates, while a spotty one can slam it shut. It's the most direct reflection of your actions as a driver. But here's the kicker, and this goes back to our story about Mark and Jessica. They both had perfect driving records. Absolutely pristine. So why was Jessica paying nearly double? Because your driving record, as fundamentally important as it is only the first chapter of the story. There are dozens of other factors at play, and many of them have absolutely nothing to do with how well you drive. They have to do with who you are, what you drive, and most importantly, where you live. And that's where the system starts to feel a lot less like a fair assessment and a lot more like a game with hidden rules. The next factor we're going to dissect is one of the most powerful and controversial of them all. It's a number that can change your premium by hundreds of dollars, even if you just move 1 mile down the road. It's a factor so precise that insurance companies know the exact risk profile of your specific block, your street, and your driveway. We're talking about your location, your zip code, and how insurance companies use it to predict your future, whether you like it or not. It's a chilling thought, isn't it? That a company can use your address to build a statistical ghost of you. A data-driven avatar that predicts how likely you are to crash your car, have it stolen, or even hit a deer. This isn't science fiction. It's the cold, hard reality of actuarial science. And your location is the cornerstone of their entire calculation. Imagine 2 identical twins, both named Alex. They have the same DNA, the same perfect driving record for 10 years. Not a single ticket or accident between them. They even drive identical 2023 Toyota Camrys, the same color, same trim. By all measures, they are the exact same risk. But one Alex lives in a sleepy suburb of Boise, Idaho. The other Alex just moved to a bustling neighborhood in Brooklyn, New York. When their insurance renewal letters arrive, the Alex in Boise sees his rate go up by maybe $20. The Alex in Brooklyn? His rate skyrockets by over $1,000 a year. Why? He didn't change. His car didn't change. His driving skills didn't change. But his environment did. And in the eyes of an insurer, the environment is everything. Insurance is fundamentally a game of shared risk. You're not just betting on yourself. You're being forced to bet on everyone around you. Your zip code is the table where that bet is placed. Think of it like a giant swimming pool. Each zip code is a different pool. The pool in Boise is filled with calm, predictable swimmers. The pool in Brooklyn is a chaotic mix of cannonballs, splashing, and 1,000 people crammed into the same space. Even if you're the most careful swimmer in the Brooklyn pool, just floating quietly in a corner, your entry fee is going to be higher because the overall risk of someone crashing into you is astronomically greater. You pay for the chaos, not just your own conduct. So, what specific ingredients make up this risk recipe for your zip code? First, and most obviously, is traffic density and accident frequency. Insurance companies have access to staggering amounts of data. They know down to the nearest intersection where the most accidents happen. If you live in a dense urban area like Los Angeles or Chicago, you are surrounded by millions of other cars every single day. The sheer probability of an incident, a fender bender, a sideswipe, someone running a red light, is exponentially higher than on a quiet country road in rural Nebraska. They aren't just guessing. They have maps, glowing with heat signatures of collisions, and they overlay your home address right on top of it. If you live in a red zone, you pay a red zone premium. But it's not just about crashes. The second factor is crime. Specifically, theft and vandalism. This is where your comprehensive coverage comes into play. You might be the safest driver on the planet, but that doesn't stop a thief from breaking your window or stealing your catalytic converter. Insurers track crime statistics with a terrifying level of precision. They know which neighborhoods have higher rates of vehicle theft. Cities like Denver, Colorado, and Oakland, California, have recently become notorious hotbeds for car theft. If you move there, even if you park in a locked garage, your rate will increase simply because the ambient risk of your car being stolen has gone up. The insurer is looking at the police reports from your area and saying, "We have to pay out a lot of theft claims in this zip code, so everyone who lives here has to chip in a little more to cover those expected losses." It's brutally simple math. The third, and often overlooked, location factor is the wrath of Mother Nature. Weather. If you live in the heart of Tornado Alley in Oklahoma or Kansas, there's a non-zero chance your car could be damaged or totaled by a storm, even while safely parked. Live in Miami or New Orleans, the risk of flood damage from hurricanes is priced directly into your policy. In Colorado and Texas, it's hail. Insurers have paid out billions for cars that look like they've been beaten with a ball-peen hammer by a hailstorm. You could have a perfect driving record, but if you live in a place where the sky periodically throws frozen rocks at your car, your premium will reflect that risk. You are paying for the statistical probability of an act of God, and that probability is tied directly to your address. Finally, there's a factor that most people never even consider: the local cost of getting things fixed. Let's go back to our twins, the Alexes. Let's say they both get into the exact same minor fender bender. The Alex in Boise takes his Camry to a local body shop where the hourly labor rate is, say, $75. The total repair bill is $2,000. The Alex in Brooklyn takes his identical Camry with identical damage to a shop where, due to higher rent and cost of living, the labor rate is $150 an hour. The same repair now costs $4,000. It's the same accident, same car, same parts, but the claim cost the insurer twice as much in Brooklyn. This applies to medical costs too. The cost of an MRI or physical therapy can vary wildly from one state, or even one city, to another. The insurance company knows this. They price the higher local costs of repairs and medical care directly into the premiums for that area. So you can see how it all stacks up. The traffic, the crime, the weather, the repair costs. It creates a complex risk profile for every single zip code in the country. And yes, it feels deeply unfair. You could be the most responsible person in your entire neighborhood. A driver who hasn't had a ticket in 20 years, who parks in a locked garage, who checks the weather forecast religiously. But you will still pay more than an average driver, who lives just a few miles away in a better zip code. From the insurer's perspective, it's not personal. It's just statistics. They are managing risk across millions of policies, and they can't possibly investigate every single driver's personal habits. So they use proxies, broad data-driven assumptions. And your address is one of the most powerful, most predictive proxies they have. It's a shortcut to understanding the world you drive in every single day. And the scary part? It's getting even more granular. With telematics and GPS data, some companies are moving beyond the zip code. They're looking at the specific routes you drive. Do you commute through a high-accident corridor every day? Do you park on a street with a high theft rate? Or in a secure private garage? The age of judging you by your neighborhood is slowly evolving into judging you by your exact moment-to-moment location. When you're shopping for a new apartment or house, you look at school districts, crime rates, and property taxes. But maybe it's time to add one more step to that process: getting a car insurance quote for that new address. That simple 5-minute check could reveal a hidden cost of thousands of dollars over the life of your time there. Your location is the invisible foundation of your insurance rate. But even if you live in the safest, calmest, most meteorologically stable zip code in America, that's only half the story. Because the very machine you are insuring, the car itself, holds a set of secrets that can either save you a fortune or cost you one. The make, the model, the safety features, even its reputation among thieves, they all tell a story to the insurance company. And that story starts with a secret code that every single car model is assigned. A number that dictates its fate from the moment it rolls off the assembly line. This code isn't some cryptic message hidden in the owner's manual. It's a complex data profile, a digital fingerprint built from dozens of variables, all derived from your car's vehicle identification number, or VIN. The moment a car is designed, long before it's even built, insurance actuaries are already running the numbers. They're creating what's called a vehicle rating symbol. Think of it like a credit score, but for your car. This score, assigned by organizations like the Insurance Services Office or ISO, predicts how much that specific make, model, and trim level is likely to cost them in future claims. A low score is great. A high score, well, that's when your premiums start to climb. So let's pull back the curtain on exactly what goes into this secret score. The most obvious factor is the car's sticker price, or its MSRP. It's simple logic. A $90,000 Mercedes-Benz G-Wagon is going to cost more to replace if it's totaled than a $25,000 Kia Forte. That part is easy, but the purchase price is just the tip of the iceberg. What lurks beneath the surface is far more important, and it's where most people get blindsided. Let's talk about repair costs. This is the silent killer of affordable insurance. You might think, I'm a safe driver, I'm not going to total my car. But what about a minor fender bender in a parking lot? 20 years ago, a cracked bumper on a Honda Accord was a few $100 for a new piece of plastic and a paint job. Today, that same bumper on a new Honda Accord is packed with technology. It has proximity sensors for parking, radar for adaptive cruise control, maybe even cameras for a 360-degree view. That minor bump isn't just cracking plastic anymore. You're now damaging sensitive electronic equipment. The bumper itself might still be a few $100s, but the sensors can be thousands. And they don't just pop in a new one. The entire system has to be painstakingly recalibrated by a specialized technician to ensure your safety systems work correctly. Suddenly, that 5-mile-per-hour parking lot incident is a $5,000 claim. Insurance companies know this. They have massive databases tracking the average repair cost for every single component on your car, from a side mirror to a headlight. And a modern LED matrix headlight on a luxury SUV can cost more to replace than the entire engine on an older economy car. So when you're choosing a car, you're not just choosing a purchase price. You're choosing a future repair bill, and your insurer is pricing your policy accordingly. Then there's the performance factor. This is where the story of two seemingly identical cars takes a dramatic turn. Imagine two brothers. They both buy a brand new Toyota Camry. On the surface, they look the same. Same color, same body style. But one brother chose the standard 4-cylinder engine. The other, wanting a little more punch, ticked the box for the powerful V6 option. He paid a couple $1,000s more up front, but he's about to pay a lot more for a lot longer on his insurance. Why? Because to an insurer, horsepower is a direct measure of risk. It's not that they think the V6 engine is inherently going to fail. It's that they know what a person who chooses the V6 engine is more likely to do. They're more likely to accelerate quickly, to merge aggressively, to test the limits. More horsepower equals more potential for speed, and more speed equals more severe accidents. A crash at 40 miles per hour is dramatically different than a crash at 80 miles per hour. The V6 Camry driver is statistically more likely to be involved in the latter. So the insurance company charges him more, not because he's a bad driver, but because he bought a car that makes it easier to be a bad driver. This applies to everything from a Subaru WRX versus a base model Impreza, or a V8 Ford Mustang versus the EcoBoost version. The engine size tells a story about the driver's intent, and insurers are listening. But it's not all bad news. While they penalize for risk, they also reward for safety. This is where your car can actually save you money. Modern vehicles are packed with advanced driver assistance systems, and insurers love them. Things like automatic emergency braking, which can prevent a rear-end collision, are a huge plus. Blind spot monitoring, lane keep assist, adaptive cruise control. Each one of these features is statistically proven to reduce the frequency or severity of accidents. Insurance companies offer specific discounts for these systems. They've done the math and realized that paying for a small discount on your premium is much cheaper for them than paying for a massive collision claim. This is why it's so important when getting a quote to be specific about your car's trim level. A base model might not have the safety package, but the higher-end trim does. If you just say you have a Ford Explorer, you could be missing out on hundreds of dollars in discounts because the quoting system doesn't know you have the technology that makes you a safer risk. And then there's a factor that has almost nothing to do with you or how you drive, but everything to do with the car you own: its popularity among criminals. Every year, a list comes out called the most stolen vehicles in America. If your car is on that list, your rates are going up. Period. It's a simple matter of risk for the insurance company. They're the ones who have to pay out when your car disappears in the middle of the night. For years, older Honda Civics and Accords were at the top of this list, not because they were easy to steal, but because their parts were in such high demand. More recently, you've probably seen the headlines about certain Kia and Hyundai models. A viral social media trend showed people how to steal them with nothing more than a USB cable. The result? The theft rates for these specific models skyrocketed. Insurance companies were losing hundreds of millions of dollars. In response, some insurers flat out refused to write new policies for those cars in certain cities. Others jacked up the comprehensive portion of the premium, the part that covers theft, to astronomical levels. So you could be the most careful, responsible owner, park your car in a locked garage every night, and still see your rates double simply because of a viral video and a design flaw. You are paying for the collective risk of every other person who owns the same car. It is, in the truest sense, guilt by association. So you see, your car's story is written in its parts, its power, its safety features, and its reputation. The price, the cost to repair its delicate electronics, the temptation of its powerful engine, the strength of its safety cage, and its desirability to thieves. All of it is fed into an algorithm. It produces that secret score, that risk profile that follows your car from the factory to the junkyard. It's a massive, complex piece of the insurance puzzle. But here's the crazy part. You could go out and buy the safest, most boring car on the planet. A beige Volvo station wagon that thieves wouldn't touch with a 10-foot pole. With an engine so underpowered it struggles to merge onto the highway. A car with every safety feature known to man. You could have the perfect car with the perfect risk profile and still pay a fortune in insurance. Because the insurance company isn't just insuring your car, they're insuring you. And they have a secret code for you too, one that has absolutely nothing to do with how you drive. This secret code is your credit score. Or to be more precise, a version of it. It's called a credit-based insurance score. And for the majority of Americans, it's one of the single biggest factors determining how much you pay for car insurance. Sometimes even more important than your driving record itself. Let that sink in for a second. A missed credit card payment from 2 years ago could cost you more on your insurance premium than a speeding ticket you got last month. How is that even possible? How is it legal? And most importantly, how is it fair? The insurance industry has a very simple and very cold answer. They have spent billions of dollars analyzing decades of data, and they have found a powerful correlation. People with lower credit scores on average file more claims. And not just more claims, but more expensive claims. Their argument isn't that having a low credit score makes you a bad driver. They're not saying that because you forgot to pay your Kohl's charge card, you're suddenly going to run a red light. Their argument is about risk management on a massive scale. They believe that how you manage your finances is a powerful predictor of how you manage other aspects of your life, including your car. To them, a person who is meticulous about paying bills on time, who keeps their debt low, and who manages their credit responsibly is, statistically speaking, more likely to be the kind of person who also gets their oil changed on time, replaces their bald tires, and generally avoids risky situations. It's a statistical bet. They're betting that a person with an 800 credit score is a more predictable, more stable, and ultimately a less expensive client than a person with a 550 credit score. And the data, from their perspective, proves them right time and time again. A study by the Federal Trade Commission, or FTC, confirmed this link. But confirming a correlation is very different from confirming a cause. And this is where the system gets incredibly controversial. Because life happens. A person can have a low credit score for reasons that have absolutely nothing to do with being irresponsible. Maybe they had a medical emergency that resulted in a mountain of debt. Maybe they lost their job during a recession and had to live on credit cards for 6 months just to feed their family. Maybe they're a recent college graduate buried under a mountain of student loans with a very short credit history. Are these people inherently riskier drivers? The system says yes. It doesn't see the story behind the number, just sees the number. This practice effectively creates what many critics call a poverty penalty. It charges people more for a mandatory service precisely when they can least afford it. If you're struggling financially, your credit score drops. Because your credit score drops, your car insurance, a legal requirement to get to the job you need to improve your finances, suddenly becomes more expensive. It's a vicious cycle that can feel impossible to escape. The backlash against this has been so significant that a handful of states have actually stepped in and banned or severely limited the use of credit scores in setting car insurance rates. If you live in California, Hawaii, or Massachusetts, congratulations. Insurers in your state are not allowed to use your credit history to calculate your premium. In Michigan, things have recently changed to also ban most non-driving factors, including credit scores. But for the other 46 states, it's fair game. And the difference it makes is staggering. According to industry data, a driver with poor credit can pay, on average, double what an identical driver with excellent credit pays for the exact same policy. We're not talking about a few bucks here and there. We're talking about a difference that can easily be over $1,000 a year. $1,000 that could be used to pay down the very debt that's hurting their credit score in the first place. So what exactly are they looking at? It's not a direct copy of the FICO or Vantage score you might see on your banking app. Insurance companies use their own proprietary algorithms to create your credit-based insurance score. While the exact formula is a trade secret, we know the key ingredients. They look at your payment history. Do you pay your bills on time? That's a big one. They look at your total outstanding debt. They look at the length of your credit history. A longer history is generally better. They analyze the types of credit you have, like credit cards, auto loans, and mortgages. And they look at how recently you've applied for new credit. But here's a detail that trips a lot of people up. It's not just about whether you pay your bills, but how you use your credit. Someone who has their credit cards maxed out, even if they make the minimum payment on time every single month, is seen as a higher risk than someone who uses only 10% of their available credit and pays it off in full. To an insurer, that high credit utilization signals financial distress, which, according to their data, correlates with a higher likelihood of filing a claim. It's not about your wealth. It's about your patterns of financial behavior. This is the invisible scorecard that follows you everywhere. It has nothing to do with your skill behind the wheel, your accident history, or the number of speeding tickets on your record. It's a financial X-ray that insurers use to judge your character, or at least your predictability. And unless you live in one of those few protected states, it's a game you're forced to play whether you like it or not. So you work hard. You start paying down your debt. You make every payment on time. You build a long, stable credit history. Your insurance score slowly improves and your rates begin to fall. You've mastered the secret code of you. You've done everything right. You're the perfect driver with the perfect car and the perfect financial record. But you could still be paying hundreds or even thousands of dollars more per year than someone just a few miles away. An identical driver with an identical car and an identical record. The only difference between you and them is an invisible line you cross on your way to the grocery store. Because the most powerful, most controversial, and least fair factor of them all has nothing to do with your car, your driving, or even your credit. It has to do with your neighbors. Because your address, your simple 9-digit zip code, is one of the most significant levers an insurance company can pull to crank your rates up or down. It's a practice called territorial rating, and it's based on a brutally simple premise. Risk is not evenly distributed. An insurance company looks at a map of the United States not as a collection of states and cities, but as a mosaic of thousands of tiny territories, each with its own unique risk profile. They are playing a high-stakes game of averages, and you are just a single data point in your neighborhood statistics. Imagine two people. Let's call them Sarah and Mike. Sarah and Mike are identical twins. They are the same age, have the same gender, same spotless driving record, same 800 credit score. They even drive identical 2022 Toyota RAV4S, same color, same trim. By every measure we've discussed so far, their insurance rates should be exactly the same. But they're not. Sarah's insurance is $700 a year. Mike's is $2,500 a year. He pays more than 3 times what she does. Why? Because Sarah lives in a quiet, rural county in Idaho, and Mike lives in the heart of Brooklyn, New York. Mike has never had an accident. He's never even gotten a parking ticket. But he pays a massive penalty simply because of where he parks his car at night. This is the reality of territorial rating. Insurers collect an ocean of data on every single zip code in the country. They know down to the city block where accidents are most likely to happen. They know which neighborhoods have the highest rates of car theft and vandalism. They know where the weather is most likely to unleash hail the size of golf balls or floods that turn streets into rivers. And they use this data to price your policy. You aren't just insuring yourself. You're being forced to collectively insure the risk of your entire community. Let's break down what they're looking at. First, and most obviously, is population density. More cars, more people, more intersections, more chaos. It's simple math. The odds of a fender bender at a 4-way stop in a sleepy suburb are astronomically lower than in the gridlocked chaos of downtown Los Angeles or Chicago during rush hour. Every single car that's added to the road in your area fractionally increases the chance of a collision, and your premium reflects that heightened risk. Then there's crime. Insurers have access to incredibly detailed crime statistics from local police departments and national databases. They know which zip codes are hotspots for auto theft. They know where catalytic converter theft is rampant. They know where cars are more likely to be broken into or vandalized. If you live in an area where your car is statistically more likely to be stolen or damaged while it's just sitting on the street, the comprehensive portion of your insurance policy is going to be significantly more expensive. It doesn't matter if you park in a locked garage every night. You are paying for the risk of your neighbor who parks their car on the street. Next is a factor most people never consider: the legal environment. Some areas are just more litigious than others. In certain counties or states, people are statistically more likely to hire a lawyer and sue after an accident, even a minor one. Juries in those areas might also be known for awarding larger settlements for bodily injury claims. Insurance companies call these judicial hellholes. If you live in one, a huge chunk of your premium is going toward covering potentially massive legal fees and lawsuit payouts, even if you're the safest driver in the world. The insurer is betting that if you do get into an accident, it's going to be a much more expensive affair in your neighborhood than it would be 3 towns over. And of course, there's the weather. A driver in San Diego, California, with its famously mild climate, poses a much lower weather risk than a driver in Miami, Florida, who has to worry about hurricanes every fall. Or a driver in Dallas, Texas, living in the heart of Hale Alley, where a single storm can damage tens of thousands of vehicles in an afternoon. Or a driver in Buffalo, New York, who has to navigate icy roads and blizzards for months out of the year. These acts of God are geographically specific, and your insurance premium is a reflection of that geographic lottery. Even the cost of living in your area plays a part. The price of car repairs isn't uniform across the country. The labor rate for a mechanic in Manhattan is going to be much higher than for a mechanic in rural Arkansas. The cost of medical care also varies wildly. An emergency room visit and physical therapy for a whiplash injury will cost more in Boston than it will in Omaha. Since your insurance has to pay for those local repair and medical bills, they charge you more if you live in a high-cost area. Now, hearing all this, you're probably thinking the same thing: this is fundamentally unfair. You're being judged not by your own actions, but by the actions of strangers who happen to share your zip code. You can be the most cautious driver, a pillar of your community, but if you live in a neighborhood with a higher accident rate or more crime, you pay the price. And this is where the system becomes deeply controversial, because this practice, while based on data, can have consequences that look disturbingly similar to redlining. While insurers are legally barred from using race to set rates, using a zip code as a primary rating factor can lead to the same outcome. Historically, minority communities have been concentrated in densely populated urban areas that, for all the reasons we just discussed, are statistically riskier and therefore more expensive to insure. So, a person living in a predominantly Black or Hispanic neighborhood in a major city can end up paying double or triple the premium of a person in a predominantly white, affluent suburb just a few miles away, even if their individual driving records are identical. The insurers argue they are just following the data, that they are race blind. But critics argue that when you use geography as a proxy, you are perpetuating a cycle of economic inequality, making it more expensive for people in poorer communities to legally drive a car, which they may need to get to a job that could lift them out of that community. The power of location doesn't stop at the zip code level. The state you live in creates a whole other layer of rules that can dramatically swing your rates. Each state has its own insurance commissioner and its own set of laws. For example, some states like Florida and Michigan are no-fault states. This means that if you get into an accident, your own insurance company pays for your initial medical bills, regardless of who was at fault. This was intended to make the process faster and less litigious, but in many of these states, it has led to rampant fraud and runaway costs, resulting in some of the highest insurance premiums in the nation. Other states are traditional at-fault states, where the person who caused the accident is responsible for the damages. State governments also set the minimum liability coverage you're required to have. In some states, the minimum is laughably low, like just $15,000 for property damage. In other states, it's much higher. All of these legal frameworks create a unique insurance marketplace in every single state. And some states have taken bold steps to change the rules. California, for instance, passed a law that banned the use of credit scores and gender in setting car insurance rates. The result? Factors like your driving record and, you guessed it, your location became even more powerful in determining your price. You could move from one side of Los Angeles to the other and see your rate change by thousands of dollars, all because the state took other tools away from the insurers. So your home address acts as a massive, complex multiplier on every other factor. It's the lens through which the insurance company views you. You could be a perfect driver with a perfect car and a perfect credit score, but if you live in the wrong zip code in the wrong state, you will never get the cheapest rates. It is a system of collective punishment, a judgment passed on you based on the collective behavior of your neighbors. And while you can work on your driving habits, and you can improve your credit, for most people, packing up and moving to a new state just to save on car insurance isn't an option. It leaves you feeling powerless. But there is one major factor left that you have almost complete control over. One that can save you hundreds, or even thousands of dollars a year, regardless of where you live. And it has everything to do with the hunk of metal and glass sitting in your driveway. Because what you choose to drive is just as important as how you drive it. But the reasons why one car costs a fortune to insure while a nearly identical one is a bargain, well, that's a story of secret safety tests, hidden repair cost ratings, and the surprising list of cars that thieves love to steal the most. Let's start with those secret safety tests. You've probably heard of the big ones: the NHTSA, the government agency that gives cars a star rating, and the IIHS, the Insurance Institute for Highway Safety, which awards those coveted top safety pick titles. And on the surface, it seems simple. A 5-star car is safer, so it should be cheaper to insure, right? Yes, but that's like saying a quarterback is good just because he can throw a football. The real story is in the details the insurance companies see that you don't. See, the IHS doesn't just crash cars into walls. They're obsessed with something else: crash avoidance. They run a whole battery of tests on a car's automatic emergency braking system. Can it stop for a car in front of it? What about a pedestrian walking out at night? A bicyclist? A motorcyclist? They test these systems at different speeds in different lighting conditions, and they grade them basic, advanced, or superior. Here's the secret. An insurance company doesn't just see Honda Accord. They see the specific trim level. They know that the base model might have a braking system that scores advanced, but the top-tier touring model has a more sophisticated camera and radar suite that earns a superior rating. That small difference, buried deep in a technical report, translates to a real-world difference in their risk. They know, based on millions of data points, that the car with the superior system is statistically less likely to be in a collision in the first place. That's a massive discount trigger. And it's not just braking. It's headlights. The IIHS found that many standard headlights on new cars are actually terrible, providing poor visibility on dark, curvy roads. So a car can only get their highest top safety pick plus award if it has good rated headlights across all trim levels. This is a huge deal. An insurer knows that the driver who can see farther down the road is less likely to hit a deer or miss a sharp turn. So if you buy the base model of a popular SUV with weak halogen headlights, while your neighbor buys the premium version with curve adaptive LEDs, your neighbor is getting a better insurance rate, partly because their car is fundamentally better at preventing a nighttime accident. You both bought the same car, but the insurance company sees two completely different risk profiles. Now let's talk about the second piece of the puzzle: those hidden repair cost ratings. This is where things get really interesting. A car can be the safest vehicle on the planet, an absolute tank that protects its occupants perfectly in a crash. But if that crash causes $20,000 in damage from a 5-mile-per-hour fender bender, your insurance company is going to have a panic attack. Every single car sold in the US is broken down into a complex web of data by the insurance industry. They know the exact cost of every part, from a side mirror to a quarter panel. But more importantly, they know the labor time required to replace it. This is a metric you almost never see on a dealership website. Think about a modern bumper. It used to be a piece of plastic and chrome. Now, it's a sophisticated command center. Behind that plastic cover, you have ultrasonic parking sensors, radar units for adaptive cruise control, cameras for the 360-degree view, and wiring harnesses connecting it all. A minor tap in a parking lot that used to be a $500 fix can now easily become a $5,000 claim. Why? Because you have to replace the $2,500 radar sensor, pay a technician 8 hours of labor to remove the bumper and install the new one, and then pay them another 3 hours to perform a complex, computer-driven recalibration of the entire system. If that calibration is off by even a single degree, the car's automatic emergency braking might not work correctly. Insurance companies live and die by this data. They know that replacing the high-tech, matrix-style LED headlight on an Audi can cost over $3,000 for a single unit, while replacing the standard LED on a Toyota might be $700. They know that a minor dent on an aluminum-bodied Ford F-150 requires a specialist body shop with dedicated tools. Driving labor costs way up compared to a steel-bodied Ram or Silverado. They know that some electric vehicles, if their battery pack is even slightly damaged in a collision, may require the entire multi-thousand-dollar pack to be replaced, sometimes totaling the entire car. This information is compiled into internal rating systems, creating a kind of repairability score for every single vehicle. A car that's easy and cheap to fix gets a fantastic score. A car made of exotic materials with sensors glued to every panel gets a terrible one. This score directly and massively impacts the cost of your collision and comprehensive coverage, the parts of your policy that pay to fix your own car. You could have two sedans, both costing $40,000, both with 5-star safety ratings. But if one is engineered for simple repairs and the other is a complex puzzle box of expensive tech, their insurance rates could be hundreds of dollars apart per year. Finally, we arrive at the most dramatic factor: the surprising list of cars that thieves love to steal. And let me tell you, it's almost never what you think. While a stolen Lamborghini makes the news, professional thieves are businessmen. They're interested in volume and low risk. They steal the cars that have the highest demand, either for the whole car or for their parts. For decades, the most stolen cars in America, according to the National Insurance Crime Bureau, have been Honda Civics, Honda Accords, Ford F-150s, and Chevrolet Silverados. Why? Because there are millions of them on the road. This creates a massive, constant demand for black market parts. A thief can steal a 10-year-old Accord, strip it down in a few hours, and sell the engine, transmission, airbags, and catalytic converter for more than the car was worth whole. Insurance companies track this data with terrifying precision. They don't just know which model is stolen most often, they know which year of that model and in which zip code. They know that older model full-size trucks are targets for their easily accessible and valuable catalytic converters. They know that certain Japanese sedans from the late 90s and early 2000s were built before sophisticated anti-theft engine immobilizers became standard, making them incredibly easy to steal with simple tools. But this market changes, and nothing proves that more than the recent viral social media disaster that hit Hyundai and Kia. A few years ago, a video spread like wildfire showing how to steal certain models of these cars using nothing more than a screwdriver and a USB cable. It was a massive security flaw affecting millions of vehicles. The result? A nationwide explosion in thefts of these specific cars. Think about what that does from an insurance perspective. Overnight, a car that was once considered a low-risk, reliable family sedan became one of the riskiest vehicles to insure in the entire country. The data started pouring in. Claim after claim, theft after theft. Insurance companies started losing incredible amounts of money on these models. Their response was swift and brutal. Premiums for affected Kias and Hyundais skyrocketed. In some high-theft cities, major insurers simply refused to write new policies for them at all, leaving owners stranded. This is a perfect, real-world example of how one single-factor theft risk can completely override everything else and turn a cheap-to-insure car into a financial nightmare. So when an insurer looks at your car, they're not just seeing a color and a model name. They're seeing a complex profile. A crash avoidance score measured in milliseconds and degrees, a repair cost index calculated down to the last nut and bolt, and a theft risk probability map that changes with every new viral video. The car itself is telling a story of risk long before you ever get behind the wheel. But that's only half the manuscript. The other half is you, the human element, the unpredictable, fallible, and ultimately most important variable in the entire equation. Because a car, no matter how advanced, is just a tool. The real risk is the person holding the keys. And the first chapter of your story, the one every single insurer reads first, is your driving record. It's your permanent record, the CV of your life on the road. That one time you were running late, and the blue and red lights appeared in your rearview mirror. That wasn't just a fine. That was a data point, a flag planted in your file that tells a story of elevated risk. To an insurer, a speeding ticket isn't about you being a bad person. It's about statistics. Decades of data show that drivers who speed are, on average, more likely to be involved in accidents. It's a direct correlation. One minor speeding ticket, say 10 to 15 miles over the limit, can increase your premium by 20 to 30%. And that increase doesn't just last for a month. It can haunt your rates for 3 years, sometimes even 5, depending on your state and insurer. Each ticket is a new entry in your ledger, and the costs compound. 2 tickets in 3 years? You might be looking at a 50% surcharge. 3. You could be pushed into a high-risk category, where premiums skyrocket, and some standard insurers might not even want your business anymore. And it's not just about speed. Running a red light, an improper lane change, following too closely, These are all moving violations that add points to your license in many states. Insurers see these points as a clear, quantifiable measure of risk. The more points you have, the more you pay. It's that simple. But tickets are just the prelude. The main event, the plot twist that can change everything, is an at-fault accident. This is the moment the theoretical risk becomes a reality. This is when the insurer has to pay out. When you report that fender bender in the parking lot or that more serious collision on the highway, a complex process kicks into gear. Adjusters investigate, fault is determined, and if that fault is assigned to you, a massive blinking red signal is attached to your name in their system. An at-fault accident is the ultimate confirmation of their fears. It proves that you are, in fact, a risk that resulted in a financial loss. The impact on your rates is immediate and severe. A single at-fault claim can easily raise your premium by 40, 50, or even 60% at your next renewal. And just like with tickets, that surcharge sticks around for years, a long-term financial penalty for a single moment of misjudgment. This is why you hear about accident forgiveness programs. It's a feature you can often pay extra for. A get-out-of-jail-free card for your first at-fault accident. Insurers know how much drivers fear that first mistake, and they've monetized that fear into a product. Now, if a speeding ticket is a warning and an at-fault accident is a major problem, then a DUI or DWI is the nuclear option. Driving under the influence is, in the eyes of an insurer, the single most reckless decision a driver can make. It's not a mistake. It's a fundamental breach of the social contract of the road. A DUI conviction instantly recategorizes you. You are no longer a standard driver. You are a high-risk liability of the highest order. Your current insurer will likely drop you at the first opportunity. Your rates won't just double. They could triple, quadruple, or more. And you'll be introduced to a new piece of paperwork, the State Route 22. It's not actually insurance itself. It's a certificate of financial responsibility that your new, high-risk insurance company has to file with the state. It's basically a guarantee to the DMV that you are, in fact, insured. It's a scarlet letter in the insurance world, a label that follows you for years, making insurance incredibly expensive and difficult to obtain. A DUI tells an insurer that your judgment is severely compromised, and they will price your policy accordingly, assuming the absolute worst. So your driving record is the story of your actions. But what about the story of your habits? Your responsibilities? Insurers want to know that too. And they found a proxy for it, a number that, to their surprise and to the frustration of many, has proven to be an eerily accurate predictor of claims. I'm talking about your credit score. This is the ghost in the machine. The number that follows you from your mortgage application to your credit card offers, and yes, right into your car insurance quote. Now your first reaction might be, what does my Visa bill have to do with how I merge onto the freeway? And it's a fair question. The insurance industry's answer is based on correlation, not causation. Actuarial studies spanning millions of drivers have shown a strong statistical link. People with lower credit scores file more claims. Their theory is that a person who is responsible with their finances, who pays their bills on time, manages their debt, and lives within their means, is more likely to be responsible in other areas of their life. They're more likely to perform regular maintenance on their car, more likely to drive cautiously, and less likely to engage in risky behavior. Conversely, they argue that financial instability can lead to stress and distraction, which can translate to poorer driving. They've also found that people with lower credit scores are slightly more likely to file small, borderline, or even fraudulent claims. Whether you agree with the logic or not, the data is powerful enough that in most states it's a cornerstone of pricing. However, this practice is so controversial that a few states, including California, Hawaii, and Massachusetts, have banned or severely restricted its use. They argue it unfairly penalizes lower-income individuals, creating a cycle where people who are already struggling financially have to pay more for a mandatory service. But for the rest of the country, it's fair game. Now, they don't typically use your FICO score that you see on your credit report. They use what's called a credit-based insurance score. It's a different algorithm, a proprietary model that gives more weight to certain factors. They're less concerned with how much you're using your credit for new purchases, and far more interested in things like your payment history, any collections or bankruptcies, the length of your credit history, and your total outstanding debt. A long history of on-time payments is a massive plus. A recent history of missed payments is a huge red flag. So an insurer builds a profile. Let's take two identical people. Same age, same car, same neighborhood, same clean driving record. But one has a credit-based insurance score of 850, and the other has a score of 550. The driver with the higher score could easily pay half of what the other driver pays. Hundreds, even thousands of dollars a year, decided not by anything that happened on the road, but by financial data. Your story as a driver is therefore written in two different languages. The language of action, your tickets and accidents, and the language of responsibility, your financial history. The insurer reads both to create a single unified narrative of who you are and how likely you are to cost them money. So you've controlled your driving, you've managed your credit, you've done everything in your power to present yourself as the perfect low-risk client. But what about the factors you can't control? The ones that were decided for you the day you were born or the day you signed a lease? What about the data points that can swing your premium by thousands of dollars before you even tell them what kind of car you drive? We're talking about demographics, and the story the numbers tell is more shocking than you think. Let's start with the one that feels the most personal, the one that's completely out of your control, your age. To an insurance company, your birth date isn't just a number. It's the opening chapter of your risk profile. And for young drivers, it's a horror story. Imagine a 16-year-old, fresh-faced with a new license, beaming with pride. They get their first insurance quote. The number that comes back is so astronomical, so utterly disconnected from the value of their 10-year-old sedan, that it feels like a typo. It's not. Here's the cold, hard math they're looking at. According to the CDC, the crash rate per mile driven for 16 to 19-year-olds is almost 3 times the rate for drivers 20 and over. They are statistically more likely to speed, to make mistakes, to be distracted, and to be involved in a fatal accident. So when that 16-year-old gets a quote for $4,000, $5,000, or even $6,000 a year, the insurance company isn't punishing them for being young. They're pricing in the statistical ghost of every teenager who made a bad turn, who looked at their phone for 1 second too long. You're not just paying for your own risk. You're paying for the collective risk of your entire age bracket. The rates typically start to drop significantly around age 25. This is the magic number where, statistically, the prefrontal cortex is fully developed, decision-making improves, and life experience begins to temper youthful recklessness. Rates continue to decline gently through your 30s, 40s, and 50s, which are often the golden years of cheap insurance. But then, something interesting happens. Around age 65 or 70, the trend reverses, and rates can begin to creep back up. The risk factors just change. Instead of inexperience and recklessness, the data points to potential issues with vision, hearing, and slower reaction times. It's a statistical bookend to your driving life. Next up, a factor so controversial that several states have banned it entirely: your gender. For decades, the industry standard was simple. Young men pay more. A lot more. A 20-year-old male would often see a premium that was 20 to 30% higher than a 20-year-old female with the exact same car and driving record. The justification was, once again, steeped in historical data. Statistics showed that young men were more likely to get into serious accidents, receive DUIs, and engage in aggressive driving behaviors. They were, as a group, a bigger financial risk. But the world is changing. A growing number of states, including California, Massachusetts, Michigan, and Pennsylvania, have passed laws that prohibit insurers from using gender to calculate premiums. In these states, your price is based on your record, not your biology. It's a move toward individual accountability, arguing that it's unfair to penalize an entire gender for the actions of its riskiest members. So depending on where you live, your gender could be a major rating factor, or it could be completely irrelevant. Now for one that makes people scratch their heads. Are you married? Seems absurd. What does a wedding ring have to do with your ability to merge onto a highway? To an insurer, it signals stability. Decades of data have shown them a powerful correlation. Married people, on average, file fewer claims. They are statistically less likely to be in accidents. The underwriting theory is that marriage often corresponds with a more settled, cautious lifestyle. Maybe you're not out late at night as often. Maybe you have a child in the back seat, which fundamentally changes the way you view the speed limit. Whatever the reason, the numbers are consistent. Getting married can often result in an instant discount of 5 to 15%. It's the insurer's way of rewarding what they see as a lower-risk life stage. Being single, widowed, or divorced can, in their eyes, place you back into a slightly higher-risk category. You haven't done anything wrong. You just don't fit the statistical profile of their safest client. But all of those factors, age, gender, marital status, are dwarfed by the absolute giant of demographic rating, your address. We're not talking about what state you live in. We're talking about your specific 9-digit zip code, your garaging address. You and your neighbor across the street could have identical cars, identical driving records, and identical personal profiles, but if that street happens to be a zip code dividing line, you could be paying hundreds of dollars more per year than they are. It is a location lottery, and it's one of the most powerful forces in car insurance pricing. Why? Because your zip code is a shorthand for a whole universe of risks. Insurers analyze your neighborhood for things like population density. Are you in a dense urban center with a high volume of traffic, stoplights every 100 feet, and a constant threat of fender benders? Or are you in a sleepy rural area where you might not see another car for miles? They look at crime statistics. Is your neighborhood a hotspot for car thefts or vandalism? If so, the risk of a comprehensive claim skyrockets. They even look at the weather. If your zip code is in a region prone to hailstorms, hurricanes, or flooding, the price for that risk is baked right into your premium. And it goes even deeper. They analyze the cost of litigation and medical care in your area. Some jurisdictions are known for having juries that award massive payouts in accident lawsuits. That risk is passed on to you. The cost of labor and parts for car repairs can vary dramatically from one city to the next. A body shop in Beverly Hills charges a lot more than one in Omaha, Nebraska, and your premium reflects that. The difference can be staggering. The exact same 35-year-old driver with a perfect record and a Honda Accord could pay $800 a year in a quiet corner of Maine, $1,800 a year in a suburb of Dallas, and over $4,000 a year in parts of Brooklyn or Detroit. You could move 10 miles and see your insurance rate double, or get cut in half, without ever changing your car or your driving habits. Finally, we arrive at the most controversial, most misunderstood, and most powerful factor of them all. It has nothing to do with your car or how you drive it, but it tells the insurance company almost everything they think they need to know about you. We're talking about your credit score. Now, they don't use your FICO score directly. Instead, they use your credit history to generate something called an insurance score. And their justification for this is a correlation that is as strong as it is unsettling. For years, massive industry-wide studies have shown that people with lower credit scores are statistically more likely to file insurance claims. The correlation is so direct that a person with poor credit could pay double, or even triple, what someone with excellent credit pays for the exact same coverage. The industry's argument is that how you manage your financial responsibilities is a powerful predictor of how you manage your other responsibilities, like driving safely and maintaining your vehicle. Consumer advocates fire back that this is fundamentally unfair. It penalizes people for life events like a layoff, a divorce, or catastrophic medical bills, things that have absolutely zero to do with their skills behind the wheel. It creates a vicious cycle where people already struggling financially are hit with higher essential costs, making it even harder to get back on their feet. Recognizing this, states like California, Hawaii, and Massachusetts have banned the use of credit information in setting car insurance rates. But in the vast majority of the country, your financial DNA is one of the primary ingredients in your insurance premium. It's a silent factor working in the background that can have a more profound impact on your rate than a speeding ticket or even an at-fault accident. So you're a married, 45-year-old woman with a perfect credit score living in the right zip code. You've won the insurance lottery, right? Not so fast, because even with all that in your favor, you could still be leaving hundreds, even thousands of dollars on the table. The game isn't just about avoiding penalties. It's about actively hunting for the hidden treasures, the discounts. And some of them are so obscure, your insurance agent might not even tell you about them unless you ask. So let's pull back the curtain on this secret menu of savings. Think of your insurance policy not as a fixed price, but as a starting price with a series of potential subtractions. Your job is to find every single subtraction you're entitled to, and it starts with the ones you think you know. The most common one, the one every commercial screams about, is bundling. Combining your auto and home or auto and renter's insurance. It's the combo meal of the insurance world. But have you pushed it to its limit? Many people stop at 2 policies. But what about bundling your life insurance? An umbrella policy? A policy for your motorcycle or boat. The more you stack with a single carrier, the deeper that loyalty discount can cut. We're not talking a few bucks here. A multi-policy discount can often be one of the biggest, sometimes slashing your premium by up to 25%. It's the first question you should always ask, but the follow-up is key. What else can I bundle for an even bigger discount? Next up is the good student discount. And this isn't just for high schoolers with a report card full of A's. If you or a driver on your policy is a full-time student, typically under the age of 25, and maintains at least a B average or a 3.0 GPA, that's a discount. But the hidden layers are what matter. Does your insurer extend this to graduate students? What about part-time students? What if you're an adult who went back to school to take a single certification class? The definition of student varies wildly between companies. Don't assume you don't qualify. Get the transcripts, make the call. It's a reward for academic discipline, because the data shows that good students tend to be more responsible drivers. But let's move beyond the basics. Let's get into the discounts you have to actively earn. This is where you take control. Consider the defensive driving course discount. Most people think these courses are just for getting points taken off your license after a ticket. That's a reactive use. The proactive play is to take an approved course voluntarily. They can often be done online in a few hours for less than $50. That $50 investment could unlock a 5 to 10% discount that lasts for 3 years. You do the math. Spending a Saturday afternoon learning to be a safer driver could put hundreds of dollars back in your pocket over the long haul. It's one of the best returns on investment in the entire insurance game. And that brings us to the modern frontier of discounts: telematics. Usage-based insurance. This is the little plug-in device for your car or the app on your phone, like Progressive Snapshot or Allstate's DriveWise, that monitors your driving habits. Now I know what you're thinking. I don't want my insurance company spying on me. And that's a valid concern. But let's be clear about what they're actually tracking. They're not listening to your phone calls. They're monitoring data points that correlate with risk. How many miles you drive, what time of day you drive, and how often you brake hard, accelerate rapidly, or take corners too fast. If you are a genuinely safe, smooth driver who doesn't treat every stoplight like a drag race, this can be a goldmine. The discounts can be substantial, sometimes up to 30 or even 40% for the best drivers. It's the ultimate put your money where your mouth is discount. You're betting on your own good habits, and if you win big. But be honest with yourself. If you have a lead foot, this could potentially backfire with some companies, so it's a calculated risk. The low mileage discount is another one that has exploded in relevance. For decades, the standard was around 12,000 miles a year. But the world has changed. Millions of people now work from home. Your commute might have gone from an hour each way to 10 steps to your home office. If you're driving significantly less than you were when you first got your policy, you must inform your insurer. Your risk of an accident is directly tied to your time on the road. Less time on the road means less risk, which should mean a lower premium. It won't happen automatically. You have to raise your hand and say, "My driving habits have changed." Now let's talk about discounts tied not to your driving but to who you are. These are the life stage discounts. Getting married? Call your agent. Statistically, married people file fewer claims. That stability translates into a discount. Bought a house? Call your agent. Homeowners are seen as more financially stable and responsible, which, in the eyes of an insurer, makes you a better risk. These are easy, automatic percentage points off your bill, just for hitting major life milestones. But the real secret weapon in this category is the affinity and occupational discount. This is where it gets granular, and where most people leave money on the table. What do you do for a living? Insurers have lists of low-risk professions that get a discount. Engineers, teachers, scientists, pilots, nurses, firefighters, police officers. The logic is that people in these detail-oriented or community-focused professions tend to be more cautious. But the list is longer than you think. Are you a member of a certain alumni association? A college fraternity or sorority? A credit union? A professional organization like the American Bar Association or the National Education Association? Are you a member of a warehouse club like Costco? Are you active or retired military? All of these groups and hundreds more have negotiated group discount rates with major insurance carriers. Sometimes these affinity discounts are surprisingly large, and your agent will almost never know to ask if you're a member of the Ornithological Society of North America. You have to tell them. Make a list of every group, club, and association you belong to, and ask your agent to check for a corresponding discount. Finally, there are the discounts for your vehicle itself. This is about turning your car into a fortress against theft and damage. The obvious ones are for anti-lock brakes and airbags, which are standard on most cars today, so that's often baked into the base rate. But what about an anti-theft system? And here the details matter. There's a difference between a passive system, one that engages automatically when you lock the car, and an active one you have to turn on. Passive systems get a better discount. And an even bigger discount comes for vehicle recovery systems, like LoJack, that can actively track a stolen car. Have you ever heard of VIN etching? It's a simple process where the car's unique vehicle identification number is permanently etched into the corner of every window. It makes the car much less valuable to professional thieves because they can't just replace the VIN plate. They'd have to replace all the glass, which is expensive and difficult. A car with an etched VIN is a less appealing target, and many insurers will give you a small but easy discount for it. So here's your mission. You need to become an auditor of your own policy. Your homework is to make a checklist. Go through every single category we just discussed: bundling, good student, defensive driving, telematics, low mileage, homeowner, marital status, occupation, every single affinity group you're a part of, and every safety and anti-theft feature on your car. Then you're going to pick up the phone. Don't email. Conversation is better. And you're not going to ask the lazy question, am I getting all my discounts? The answer to that will always be yes. Instead, you are going to lead the conversation. You're going to say, hi, I'm doing a full review of my policy to ensure I'm maximizing my savings. I'd like to go through a checklist with you. And then you go down your list one by one. First, do you have me listed as a homeowner? Great. Second, I'm a member of the State Alumni Association. Is there an affinity discount for that? Okay. Third, my daughter is on the dean's list at her university. Can we apply the good student discount? And finally, my new car has a passive anti-theft system and daytime running lights. Are those discounts reflected? This changes the entire dynamic. You are no longer a passive customer. You are an informed partner in your own policy. By stacking these discounts, a little here for your job, a little there for your driving course, a big one for bundling, you can systematically chip away at your premium, potentially saving hundreds if not thousands of dollars a year. It's work, yes, but the payoff is immense. This is how you get the absolute best price from your current insurance company. But what if, even after applying every single discount, your insurer still isn't the cheapest option? What if another company's starting price, their base rate, is so much lower that their non-discounted premium still beats your fully loaded, super discounted rate? That's when you realize that getting discounts is only half the battle. The other half, the one that can lead to the most dramatic savings of all, is entering the final stage of the game, the art of comparison shopping. And that is where we're going next. This is the moment where the informed consumer becomes the empowered consumer. Because comparison shopping isn't just about finding a cheaper price. It's about fundamentally shifting the power dynamic. For years, the insurance industry has thrived on something called inertia. The idea that once you're a customer, you'll likely stay a customer because switching feels like a hassle. They might even reward this inertia with a loyalty discount, making you feel valued. But here's the dirty little secret of the industry: the loyalty penalty. Countless studies and consumer reports have shown that long-term customers often pay significantly more for the exact same coverage than a brand new customer would. It's insane when you think about it. Imagine going to the same coffee shop every day for 5 years, and on your 5-year anniversary, they start charging you $6 for the same latte they sell to the person in line behind you for $4. You would be outraged. You'd walk out and never come back. Yet, with insurance, because the process is opaque and the bills come automatically, millions of people pay this penalty every single year without ever knowing it. They're paying for their loyalty. Your mission, should you choose to accept it, is to obliterate that penalty. The way you do that is by making the companies compete for your business. Not once when you first get a car, but regularly. Think of it as an annual financial health checkup. Once a year, you review your policy and you put it on the open market. This isn't disloyal. It's just smart. You are the CEO of your personal finances, and you have a fiduciary duty to yourself and your family to get the best possible value for your money. So how do you do it right? How do you shop like a pro, and not just waste an afternoon clicking through a dozen confusing websites? It's a 3-step process. Gather your intel, choose your arena, and compare apples to apples. First, gather your intel. You can't go into battle without your weapons. Before you even type a single URL, have these things ready on your desk or open in a tab. 1. Your current policy's declaration page. This is the holy grail. It lists all your coverages, your limits, your deductibles, and what you're paying for them. 2. The driver's license numbers for everyone on your policy. 3. The vehicle identification number, or VIN, for all cars on the policy. And 4. A rough idea of your annual mileage. Having this information ready beforehand turns a frustrating hour of searching for documents into a smooth, 10-minute data entry process. Second, choose your arena. There are 3 main ways to get quotes, and the best strategy often involves using a combination of 2 of them. The first way is going direct. This means you go straight to the websites of individual insurance carriers: Geico, Progressive, State Farm, Allstate, you name it. The pro is that you are getting the most accurate quote directly from the source. The con is that it's the most time-consuming. Going to 5 different sites means entering your information 5 different times. The second way is using an independent agent or broker. These are professionals who represent multiple insurance companies. You give them your information once, and they do the shopping for you, presenting you with several options. The huge pro here is expertise. A good agent can give you advice, help you understand complex coverages, and find carriers you might have never heard of. The con is that they don't represent every company. Some of the biggest players, like Geico, only sell directly to consumers, so an independent agent can't give you a quote from them. The third way, and the one that's exploded in popularity, is using online comparison sites. Think of companies like the Zebra, Insurify, or Jerry. These are aggregators. You enter your information once into their platform, and their technology pulls quotes from dozens of insurance partners in minutes. The pro is obvious: speed and efficiency. It is the fastest way to get a broad snapshot of the market. The con: the quotes are sometimes estimates that can change once the insurer does a full pull of your records. And you need to be aware that your information is their product. You might get follow-up emails or calls. So what's the winning strategy? Pick 2. Maybe you go direct to 1 or 2 of the big companies you know, and then use one online comparison tool to sweep the rest of the market. Or you call one independent agent and then use a comparison site to see if they missed anything. This combination approach ensures you're getting a wide view without spending your entire weekend on it. Now for the third and most critical step. Compare apples to apples. This is where almost everyone gets it wrong. You get 5 quotes back. One is for $900 a year. Another is for $1,500. The $900 one seems like a no-brainer, right? Wrong. It's only a no-brainer if the coverage is identical. That cheaper quote might have dropped your liability limits to the state minimum. It might have a $2,000 deductible instead of your current $500 one. It might have completely removed rental car reimbursement or roadside assistance. A cheaper policy is not a better policy if it leaves you dangerously underinsured. This is why you gathered your intel first. You have your current declaration page right in front of you. As you look at each new quote, you must go line by line. Bodily injury liability. Does it match? Property damage liability. Does it match? Uninsured motorist, collision deductible, comprehensive deductible. Match, match, match. Only after you have confirmed that 2 policies offer the exact same level of protection can you then look at the price tag and make a true, informed decision. This all might sound like a lot of work. It's not. We're talking about 1 hour once a year. Let me reframe this for you. Let's say you follow this process and you find a new policy that is identical to your old one, but it's $400 cheaper for the year. You just paid yourself $400 for 1 hour of work. Would you turn down a job that pays $400 an hour? Of course not. This is one of the highest paying part-time jobs you can ever give yourself. And once you have the quotes, remember that price isn't the only factor. If 2 companies are within a few dollars of each other, now you can look at the tiebreakers. Check out customer service rankings from places like J.D. Power. Read reviews about their claims process. Is one company known for a smooth, easy claims experience while the other is known for fighting its customers tooth and nail? That knowledge is worth paying an extra $10 a month for. Download their mobile app. Is it easy to use? Can you see your ID cards and file a claim easily? The quality of the company matters when you actually need them. So let's bring this all home. Over these 10 parts, we have dissected every conceivable element that goes into your car insurance rate. We started with the things you can't control, like your age and your location. But then, we systematically moved through everything you can control. The car you choose, the way you drive, the way you manage your credit, the discounts you actively seek out. And now the final, most powerful tool in your arsenal: your willingness to force competition. Insurance isn't a fixed price. It's a complex, dynamic algorithm, a conversation between your risk profile and a company's business model. For too long, most of us have just been passively listening in that conversation. But now, you understand the language. You know what they're looking for, you know what they're rewarding, and you know what they're penalizing. You have the playbook. The single greatest factor that affects your car insurance rate is not your zip code. It's not your driving record. It's not even the car you drive. The single greatest factor is your own engagement in the process. It's your decision to stop being a passive ratepayer and become an active, educated consumer. It's the choice to take 1 hour once a year to put the power back where it belongs, in your hands. The system is no longer a mystery. The game is set. The savings are real and they are waiting for you. All you have to do is play.